Hello friends, welcome to our channel Accounts and Finance with FARSK. This is our video on the first part on the series on inventory in accounting IAS2, Fifo and Lifo. Hope you will like, share and subscribe our channel. Inventory in accounting 1, IAS2, the first part, Fifo and Lifo. Inventory methods of valuation. Regards to inventory procedures set out in IAS2, our interest is to know at what value should a company's inventory be recorded, what is included in a company's inventory at year end, the valuation of inventory on the balance sheet by using lower of cost or market, and estimating inventory when it is not able to be calculated. Because the inventory that a company buys has different prices each time it is purchased, the company must have a method to determine which unit is sold each time it sells a unit of inventory. This is important because it affects the ending inventory and the cost of goods sold, and therefore the profit for the company. The different methods are as follows: first in, first out, that is Fifo; last in, first out, that is Lifo; weighted average; and specific identification. First in, first out, that is Fifo. Under Fifo, the most recently purchased inventory items are included in ending inventory on the balance sheet, which is very normal for any business. The assumption here is that the oldest item in inventory is always the item sold. In addition, it is assumed the most recently purchased items are still in inventory at the end of the period. An example of the FIFO method is a fruit stand. When someone buys an apple, the seller will try to sell the oldest apple first, because if it perishes or spoils before its sale, it will become obsolete, creating a loss for the fruit stand. However, unless inventory is highly perishable, as apples are, it does not matter whether or not the actual earliest item stocked is the item sold. Whether it is or not, the assumption is made that the earliest item stocked is the item sold each time a sale occurs. In a period of rising cost, using FIFO will result in a higher ending inventory balance and a lower of cost of goods sold, that is COGS, and therefore higher operating income when compared to LIFO. This occurs because the newest highest cost units of each inventory items are still on hand at year end, higher ending inventory resulting, and the oldest lowest cost units of each inventory item were sold during the year, that is lower cost of goods sold. Note, under FIFO, ending inventory is essentially valued at current cost or replacement cost, and cost of goods sold is reported at an older historical cost. Therefore, the balance sheet has current figures because the inventory is valued at the more current cost. First in, first out example. Date, purchase units, rate, issued unit, rate, balance, total. For example, you have purchased 120 pieces on 5th of January at the rate of 120. The inventory will be 14,400. And you have issued or sold 100 units out of this on 22nd January, then your inventory will be 2,400. And on 3rd March, you again purchase 50 units at 125. Therefore, the old 120 and the new 50 will become your inventory 8,650. On 14th May, you have sold or issued to 20 units, that is from the first lot at 120 rate. You will get the inventory balance as 6,250. Whereas you have sold or issued 35 units on 21st of July at 125, that is second, because the first inventory or the stock which was purchased on 1st of May, 120 pieces had already been sold, and now this from the second inventory lot you will sell 35 pieces at 125. So the balance you will get is 1,875 stock. On 3rd of September, you have purchased 20 units at 140. Therefore, these 20 units of 100 at the rate 140 plus the old stock of 115 units 125 will be your balance in inventory, that is 4,675. And next is on 10th 8th October, you have purchased another unit of 30 pieces at 150. So inclusive of all the stocks, your balance in inventory will be 9,175. Now, on 4th of November, 15 units have been sold at 125, which is the oldest one, getting you a stock inventory balance of 7,300. And on 18th November, uh, 20 units have been sold at 140 rate, which is getting our inventory 4,500. And on 7th of December, 5 units have been sold at 150 rate, that is so the balance will be 25 units, which is the last pieces remaining, and you will get the inventory balance on 31st of December as 3,750. The benefits of Fifo, first in, first out. As we detailed at the previous slides, that in a reported of rising prices, cost of goods sold will be lower with FIFO than with the other cost flow assumptions, because the oldest lowest cost inventory will be assumed sold for each sale. Consequently, reported net income will be higher than it would be with other cost flow assumptions, which may be of benefits to some companies. When FIFO is used, inventory on hand will reflect more current market prices than would be the case in the other cost flow assumptions, because the inventory on the balance sheet will be reported at the cost of most recently purchased items. Also, in the US, Fifo is the only inventory cost flow assumption that is not restricted in its usage for income tax purposes by the IFRS. But Fifo also has some limitations. The first limitation is, although reported net income is higher under Fifo than under other cost flow assumptions, net cash flow will probably be lower. In a period of rising prices, taxable income will be higher, and higher taxable income means higher income taxes paid, which decreases net cash flow. Use of FIFO when prices are increasing or rising creates short-term, overstated operating income that is not sustainable due to lower cost units purchased long ago being the ones expensed as cost of goods sold. Last in, first out inventory. This is the second method. When LIFO is used, the assumption is made that each item a unit is sold. It is the one that was purchased more recently. The newest item in inventory. Therefore, the oldest inventory items and the lowest cost items, assuming rising prices, will be included in ending inventory on the balance sheet. In a period of rising prices, LIFO will create a lower ending inventory balance and higher cost of goods sold, that is COGS, and therefore lower operating income when compared to FIFO. At year end, the lowest or oldest cost items are still in inventory, and the newest highest cost units have been sold and are expensed on the income statement as cost of goods sold (COGS). LIFO is permitted to be used only in the United States under rules set out by GAAP, that is generally accepted accounting principles. Last in, first out. LIFO illustration. Let's say you are the owner of a clothing store and you ordered 10 shirts at $100 each. 3 days later, you made another order of 200 shirts at $150 each. After a week, your inventory showed that 150 shirts have been sold. You now want to record the inventory cost. If you are to make the use of the LIFO method, how much can you put down as the cost of goods sold (COGS)? Now we are assuming that all the shares are sold at the same price of $500 per shirt. However, the price at which you brought them varies. When calculating the cost of the shares, you would calculate it at $150 per share price, since this is the last known price of your inventory purchase. This will mean that cost of the shares will be recorded as $225 at $500 per price, sales price. The income will be recorded as 500 by 150. 2,250 is minus. The profit made on those 15 shares will be $5,250. This means that even though you bought the first 100 shares at $200 price, the first shares to be calculated will be the last ones that were bought. Last in, first out example, LIFO. First, let's say you have purchased on 1st May 2022 120 units at the rate 120 price. That is the same example as we have taken on Fifo. So the balance will be 14,400. On 22nd of January, you have issued out or sold out 100 units at 120 price, leaving the inventory at 20 stocks units at 120 price. It is 2,400 will remain the stock. And then on 8th of March 2022, you have purchased another 50 units at 125, which will make your balance of inventory at 8,650. On 14th May, you have issued or sold 50 units at 125, leaving your inventory balance at 2,400 because you're selling here from the light stock of 50. And then on 21st July 2022, you have issued or sold another 5 pieces at 120 rate, leaving your stock at 15 by 120, which is the oldest price. 120, of course, is the oldest price. So the ending stock will be 1800. On 3rd of September, you have purchased another pieces at 20 pieces at 140 rate, leaving your stock available at 4600. On 8th of October, again you have purchased 30 pieces at 150 price, leaving your stock at 9100. On 4th of November, you have sold out 30 units, and the, because we are using Lifo, we will be using on the recently purchased item, that is item price, recently purchased item price, that is 150, leaving your inventory balance at 4600. And on 18th November, you have again sold 10 pieces at 140, which is the latest price, and leaving your inventory at 3200. Lifo benefits. Lifo is sometimes the best match for the way goods physically flow into and out of inventory. When new inventory is received and displayed for sale, items may be placed in front of the existing inventory unless a concerted effort is made to position newer items behind older ones. If newer items are consistently placed in front of the older ones, the newest units are always the units sold. LIFO better matches current costs against current revenues and therefore provides a better measure of current earnings. When prices are rising, use of LIFO leads to better quality earnings. The primary advantage of LIFO is that when prices are rising, the use of LIFO for tax reporting results in a higher cost of goods sold (COGS) and lower taxable income. Lower taxable income leads to lower income taxes and higher cash flow. But there are some limitations in LIFO. If a company uses LIFO for its tax reporting to gain the advantage of lower taxes, the tax law in the US requires that company may also use LIFO for its financial reporting. Therefore, the company's reported earnings will be lower than they would be under the other cost flow assumptions, assuming rising prices. Tax, tax law does not have a similar requirement for other inventory cost flow assumptions. Since the items reported as inventory on the balance sheet will be earliest items purchased when prices rise, inventory will be valued too low on the balance sheet. If sales exceed purchase of inventory, layers of old inventory will be liquidated. The old cost will be matched against current revenues and will cause an increase in reported income for the period in which the liquidation occurs. A company using LIFO may be able to manipulate its net income by altering its purchasing pattern at year end. And of course, using LIFO for inventory valuation is not permitted if a company is using IFRS standards. Well, that's it for today. Hope you like our video. For more videos, please do not forget to like, share and subscribe our channel, Accounts and Finance with FARSK. Thank you.